This is InvestTalk. Independent thinking, shared success.
Hello, this is Suzanne from New Jersey. I'd appreciate your take on American Power Corporation. Thanks very much. Bye-bye.
Alrighty, American Electrical Power Company, ticker AEP, is exactly what it sounds like. It's one of the U.S.'s largest electrical utilities, has almost 6 million customers across 11 states, with 39,000 miles of transmission lines. It's had a pretty decent year so far, pretty solid 52 weeks, up 10.18% year to date, up 15.81% over the past 52 weeks. Its growth also is pretty solid for a utility company, 5.1% on an annualized basis, going back to December of 2019. And its margins are pretty solid too, in the low to mid-teens, sitting at about 14.9% this year, projected to dip a little bit to about 14.6% net margin next year. It's got quite a bit of debt, about $39 billion in debt on a $54 billion market cap company. So what's been going on with this company? Well, Q1 2025 earnings beat. They had reported adjusted EPS of $1.54 versus expected $1.40. Looks like they've had some big transmission investment partnerships with KKR and PSP, who took about a 20% stake in one of their transmission units, about $2.8 billion. So money is not hard for them to raise. And they've also seen some positive changes and some positive trends, right? A lot of what has happened with this company they have been benefiting from big tech's infrastructure build out. The spurred commercial growth from AI and data centers. They've seen a transmission business that has exploded in a positive way. Certainly we don't like utilities to explode, but in a positive way. And they also have a pretty stable dividend profile, about 3.7%, sits about 3.6 right now, and that's where it's been over the past 4 or 5 years, and its payout ratio is only 63, so it's not strained too much in paying out those dividends, and its cash flow is pretty solid as well. Look at this net operating cash flow, $6.3 billion, pretty steady growth over the past 6 years, though free cash flow notably is negative. From a relative earnings basis, it's trading about 16.8 times, which is about its average. I think that this company is a solid company because it has benefited from what has been driving markets higher for about 2 years. And I've been saying for a while, one of the best low volatility ways to invest in the AI theme is not necessarily to just invest in those companies that are pursuing software, but the companies that are benefiting from the infrastructure build out and the companies that would benefit from the eventual products that are launched. We do own this name for some of our clients and one of our strategies, so we like it. That is American Electrical Power Company, ticker AEP. Alrighty, let's get to this question from our good friend Gil, who has a question about AutoZone, ticker AZO. As I struggle to find my mouse here, the question is, thanks for all the insights. AutoZone has pulled back a bit. What is your take on this business? Is it a good opportunity? So AutoZone is a retail and distribution company in the auto parts space. It's the largest retailer within the United States, actually, on aftermarket auto parts. I'm sure you have one in your neighborhood. And it's had a bit of headwinds, let's say, over the past 3 months. It's got solid performance year to date. It had solid performance over the past 52 weeks. Had a rough 23 and 2024. And one of the reasons why it is lagging a little bit is it struggled in terms of its earnings, right? They had mixed earnings results. Net income fell for the quarter. But in spite of this, you did see a little bit of optimism and upgrades, right? Because you have tariffs continually kick down the road. You have still a pretty robust share repurchase program. I mean, they went from 24 million shares outstanding 5 years ago down to about, 16 and change. So in spite of not paying a dividend, you were still getting capital returned to you as a shareholder. But growth has certainly slowed, right? You're seeing growth, which was at 1.10% on an annualized basis, coming in at about 5%-ish year over year here. And at the same time, you're seeing margins kind of compress a little bit from 14.9% is the local high down to about 13.4% this year. Now, in terms of debt, it doesn't have much of it. It's got $12 billion in debt on a $60 billion market cap company. But like these trends are not great, right? So margin trends are certainly not good. And quarterly earnings were certainly not good. But I think there is still a lot that AutoZone can benefit from moving forward, right? Potentially, if there's a removal of this overhang of tariffs, which would greatly affect some of the costs that this company and companies like it face. Now, after this run up over the past year to date, up 12.58% again, it's trading pretty expensive for an auto parts supplier, I would say, at 22.1 times forward-looking earnings, about 20 times cash flow. So I think this run up makes it a little too expensive for me. It's pulled back a little, but not enough.
For comprehensive investment resources, visit us at investtalk.com.
Hi, Duncan from New York. Thank you for all that you do. I just learned that there's two investing vehicles, ETFs, that represent what congressmen trade. I don't know if you have time to quickly go over like both of them, but one of them is called the NANC one. NANC represents the Democratic Party, and the KRUZ ETF, KRUZ. Reason why I'm looking into this is because, well, I mean, obviously insider trading would probably get a head start. It seems like they're doing pretty well compared to the S&P 500. Wanted to know your 2 cents. I know that there needs to be an expense ratio to look at, but the idea kind of makes sense, right? Like it's an easy set it and forget it. I could either put it in my brokerage account or in my retirement account, but just want to know your 2 cents. Thank you. Bye.
Alrighty, so from what I can see, the two tickers are NANC, which is the Unusual Whales Subversive Democratic Trading ETF, and the other is actually GOP, which is the Unusual Whales Subversive Republican Trading ETF. And so what both of these try to do is track both sides of the political aisle, including their families, because under the Stock Act, congressional members and their families disclose their trading activities through periodic transaction reports. And so through these reports, they attempt to create a index, though I'm not sure how the index is weighted, if it's the weighted average dollar value that they see from any of these reports. But regardless, okay, so let's take a step back. There is a complaint about, quote, insider trading. When congressional members trade on information, it isn't always insider information, right? Insider information is material, non-public information. And most of the time that doesn't pass through Congress. There are instances where it does, right? So maybe you are getting people who traded in Citrix back in the day, right before the pandemic, because they were getting briefings on that the public didn't hear about how bad COVID could potentially be. And I don't want this to sound like I think these people should be trading. They certainly should not be trading. I think that if you're in Congress, you should not be doing this. But regardless, this sounds on its face like a great idea, but when you dive in, there's some things here, right? So first, the management fee, 72 basis points. So pretty expensive, considering all they're doing is really just taking public disclosures, and I'm assuming market cap weighting. Over the 1 year, it's underperformed the Qs. Qs returned about 15, 16%. It's returned 12.26%. But when you dive into the holdings of supposedly this insider information traded ETF that they're marketing, look at the names they're holding. The top 10 names make up 45.95%. Top weight, NVIDIA at 10, Microsoft at 8, Amazon at 5.28, Philip Morris at 373, Salesforce, Netflix, Costco, American Express. These aren't some names that you are only hearing about because there's some sort of insider information from congressional members. This is just holding the Qs, and the Qs perform better. And so, I don't necessarily think that, it's always take it with a grain of salt. There are many trades that congressional members make that are also bad trades, right? And so it's similar in when you see insiders within companies, CEOs that are purchasing or selling stock. It is all one part of a larger picture. But in this specific instance, for these ETFs, I don't think it's worth the management fee. Again, this is just holding things from the Qs. And the other one, GOP, let's take a look at it really quick. 72 basis points here. 80% in large caps. It holds 5% Bitcoin, JP Morgan Chase, Comfort Systems, NVIDIA, AT&T, Allstate. I don't know. There are cheaper ways to attack this. So I'm going to have to pass on both of these. Those are tickers, what was it? NANC and GOP. Thanks for the call. All right, let's keep things moving and play another listener question now.
Hey guys, love the show and thank you very much. I was calling about the ticker PAC, that's Papa Alpha Charlie. It's Aeroportes Pacificos, one of the Mexican airport stocks. They own Tijuana and Guadalajara airports, among others, and I'm wondering if you guys had any thoughts on this ticker. Thank you very much. Bye.
Okay, the ticker is, again, PAC. It is an ADR from Mexico, trades on the New York Stock Exchange, operates 12 airports along Mexico's Pacific coast and 2 in Jamaica, including some key hubs. So they got Puerto Vallarta, they got Guadalajara, and Montego Bay. It is a $11.5 billion market cap company. It's got a little bit of debt, about $1.63 billion in debt. It's up 27.93% year to date, up 37.47% over the past 52 weeks. So it's had a pretty solid year overall. And from a relative strength perspective, it's been really strong against the S&P since about the middle to end of 2022. Revenue growth, phenomenal, though most of it is kind of backloaded here between 2020 and 2022. Growth has certainly slowed down, but it's averaging about 16.8% on an annualized basis over the past 5 years. And margins are solid as well, reaching as much as 33% net margin before the pandemic, post-pandemic high of about 32.9 in 2022. Still a solid 29, even though margins are contracting a little bit. Free cash flow growing, net operating cash flow is growing as well. And a lot of it is because there's been a huge traffic surge, right? People spending a lot of money coming out of the pandemic. They had a lot of money to spend on travel, but also business investment in Latin America or in Mexico as well. And so because of this, you're seeing forward-looking price to earnings a little bit expensive, though, relative to the past 5 years. Near its average, about 18.9. Price to book 9.4. Price to cash flow 18.4 as well. You know, I kind of like this name. I think that it is a more stable infrastructure play that you can make while also understanding that there's a lot of growth potential there. If you have an inclination from this administration to move away from manufacturing in the East, talking about the Far East in Asia, and move closer towards the United States, well, this can certainly be a big beneficiary there. Now, they recently did have a miss in Q1, and they are reporting earnings in just about over a month now. But I think that so long as you don't have, and you thus far, you have seen diminishing trade tensions between the United States and Mexico specifically. So long as you still have that dynamic, this can certainly be a good investment. And it looks like it's at a decent price relative to where it's been in the recent past. And so it's down about 2.16% today. Let me look at this chart real quick on this side over the past year to date. I mean, it looks like it hit some resistance over there at about 238, maybe trying to find some support here. I don't know if now is a good entry point because it had a big run up all the way from April, coming after Liberation Day. I'd wait for it to finish this price discovery here to find some more support. But either way, I'd keep it on my list and I would look to buy in soon. That is ticker PAC, Grupo Aeropuerto del Pacifico. Portario, apologies. All right, let's keep things moving. Talk a little bit more about another thing that is affected by tariffs, and that is the Fed's decision to cut or not to cut rates. That is the question. Now, despite mild inflation data, some softer than expected in some ways inflation data, Fed is unlikely to cut rates tomorrow. And that's because you still have concerns over tariff-driven inflation risks. And that can take time to show itself in the data. Officials are evaluating how new volatile tariffs can potentially unanchor inflation from that 2% target that they are historically chasing. And when they look at what this is doing, right, when they look at the overall picture, you have to be careful because what you're seeing is CPI, PPI, PCE, that's backward-looking data. But you're also concerned about forward-looking data. And so when you look at, consumer expectations, you look at business expectations, estimates are higher. Estimates are higher. Businesses and consumers think inflation will be a lot higher moving forward because of some of this uncertainty. University of Michigan survey showed a sharp rise in expectations. New York Fed and market-based measures showed increases, albeit smaller, but increases nonetheless. And so when you're the Fed, you're still trying to do this balancing act. You have to remember, the Fed has effectively a dual mandate and then also the stability of the financial system, but they're worried about labor and they're worried about unemployment and they're worried about inflation. And typically when you do things to affect one, the other moves in the opposite direction. And so yes, inflation's coming down, but you're seeing some labor market deterioration as well. And there are risks. There are risks. They don't want to mishandle the labor side, but you can't ignore the fact that recent actions, recent memory has scarred them. The 2021 transitory mistakes from the 1980s. Nobody wants to repeat that, and so officials are cautious of cutting too soon. Younger consumers, interestingly enough, and maybe it goes along with the report we had yesterday about unemployment amongst young consumers, actually have higher inflation expectations than older generations. Now, among the governors, Governor Waller sees tariffs as a one-time bump, not really a persistent threat, but there are others that think it could be a potentially persistent threat. Either way, the Fed is weighing what to tackle: inflation, jobs, and being more cautious given recent history. Because of this, it'll be interesting to see what they come up with in the dot plot tomorrow. Where are we headed in the future? Alrighty, let's pivot back to the InvestTalk voice bank now.
Hi, this is Francisco from Stratford, California, and I'm calling in for a stock VST. It's in the utility sector, and I'm just wondering, is this technical chart look like it's getting ready to do the golden cross? I just had that question, and maybe you could tell me a little bit about the fundamentals. Looks a little expensive, but is it going to grow into these earnings? All right, thank you. Have a good day.
Alrighty, let's take a look at ticker VST, which is Vistra Corp. And Vistra Corp is a natural gas, nuclear, solar, battery generation company, primarily within the retail space. It looks like about 52% comes from its retail business, about 23% from its Eastern business, and about 22% from its Texas business. Recently, they've had several ratings upgrades. Q1 2025 results did show a net loss, but adjusted EPS did rise, and they reaffirmed guidance as well. They did have some recent acquisition, which is expected to complete in late 2025. And more than anything, same thing we went over with AEP, a lot of tailwinds on the AI data center, energy infrastructure, energy demand front. Now, it's a $61 billion market cap company. It has a little bit of debt, about $17 billion in debt, though not too much. Pays a 51 basis point dividend yield, payout ratio about 12. Certainly more room to grow that dividend there. A little bit of short interest, buys back a bunch of shares, consistently buying back shares since it instituted a program at the end of 2021. Cash flow looks like it's been improved pretty steadily. Net operating cash flow up from $485 million to about $5.3 billion is where it's projected to grow this year. End of last fiscal year is at $4.5 billion. Margins lost money in 21 and 22, started to make money again, peaked out at 13.7, compressing a little bit, still 9.7, pretty respectable. But given the growth, right, it's trading pretty expensive. 24.3 times forward-looking earnings for a power generation company, 12.4 times price to cash flow. And from a technical standpoint, let's look at its momentum real quick on 1 year. I mean, it's been pretty strong since April 4th, just around Liberation Day, marching consistently higher. So over the past year, it's up 111%. Year to date, it's up 28.93%. Over the past 3 months, it's up about 40% as well. And so, looking at this, honestly, the leverage ratio looks pretty decent from my perspective. Again, not a lot of debt. Interest coverage ratio sitting at about 3.89%. You also have energy tailwinds. Same thing we talked about with AEP. You have the data center demand, the AI demand. But overall, with the growth that we've seen, it looks a little expensive to me, and the valuation looks a little bit stretched, trading at about 24.3 times forward-looking earnings. Looks like we are still a bit away from our next earnings report, but I am seeing some upgrades. I'm really conflicted here because of the run-up in this company. Let's look at the upgrades here. Looks like UBS gave them a ratings upgrade. It's had some acquisitions. Q4 earnings were decent. It is a tough one. Either way, I think that it's had a pretty decent run-up right here. I wouldn't enter a full position at this point. It could continue to march higher. Momentum is a very strong and powerful thing. So I would probably, if you wanted to enter in now, I'd probably give it a half position, maybe a quarter position, and dollar cost average in over time. You have a bit of time before earnings. You asked if I think it's going to grow into earnings. No one can really predict that. And so understanding the dynamics that you've seen thus far from what we've seen out of AI-related companies, CapEx not slowing down, certainly beneficial for here. But keep in mind, it is pretty stretched at 24.3 times forward-looking earnings, 12.4 times cash flow. That's Vistra Corp, ticker VST.
Stay informed with exclusive insights by subscribing to the KPP Premium newsletter today.
Good morning. This is Sayed from Chicago. I've been listening to you guys for quite a long time. I really appreciate what you guys do. I've learned a lot of stuff from you guys. I have a question about XLU, that utility ETF. Is it a good time to get in? I want to know your take, what you think about it. I like to invest in this. So please let me know. Thank you very much, sir. Thank you.
All right, taking a look at XLU, that is the Utility Select Sector Spider ETF. Very cheap. It is a hugely popular fund. All it does is it looks at the utilities names within the S&P 500 as a market cap weighting and adjusts anytime the S&P adds names. As you'd expect, 96.23% in energy utilities and super cheap, about 9 basis points. Now, over the past year, it's up about 19.25%. It's because utilities have had a pretty strong past 52 weeks. But month to date, it's down about 1.10%. There's a lot of reasons for that. Rising cost of debt, better yields on short-term government securities, right? A lot of people invest in utilities because of the yields of the income. And when you can get pretty solid income for very low risk, very cheaply, people tend to stay away from REITs and utilities. Now, if you want to get exposure that is broadly diversified, right, you got 33 names from the S&P 500 in here. I think this is a perfectly reasonable way to do it. But I think the utility sector is a good way to exercise themes as well, right? So we have within our portfolio some exposure to natural gas utilities that have done really well in the wake of the growth in demand for natural gas for AI and data centers. And so, if you're looking to thematically invest, utilities can be a good way to do it. But if you want this broad exposure, you want it very cheaply, XLU is a solid choice. All right, before we head off for the day, an interesting story, because all we talk about these days are tariffs and rising costs and input prices. But what we've seen is the spot rate to ship a 40-foot container from Asia to the United States. Price that is down 27% from recent highs. The Shanghai Containerized Freight Index fell 6.8% last week, driven by the sharp decline in those specific shipping rates. And so what you can maybe assume is that this temporary surge potentially caused from the increased demand headed into Liberation Day and after Liberation Day, trying to front run a lot of these tariffs. The price impact of that is diminishing a bit. Carriers attempted to continue raising prices in June, but because demand fell, well, that didn't really hold. Retailers and manufacturers now, because of this, are focusing on finding those lower cost options, which in turn makes it cheaper for the products that consumers are buying at the end. Now, it's important to note, right? This is just a short-term trend. It could be possible that the reason why demand is so low is because of all that front loading. And so as you diminish that inventory, as you sell a lot of that inventory, as you have to re-up on that inventory, demand could certainly come back, and it could certainly raise the price as shipping lanes are potentially disrupted by what is going on globally. Geopolitical risk in shipping is certainly a real thing, but for now, it looks like a steep fall is expected. Import volumes are projected to drop in August and sharply decline through the end of the year, meaning for retailers who were looking at having to raise costs in the wake of import taxes, which is what tariffs are, may get a little reprieve on the other side. Retailers, though, do remain cautious. You don't want to, as a business, have excess inventory for too long. And so a lot of them may be seeing these cheap prices, but if we continue to see weak consumer spending, well, the amount of ships moving across the globe may slow down as well. Alrighty, I'm Luke Guerrero. This completes another InvestTalk program. Justin and I thank you for listening, and once again encourage you to tell one friend, one family member about our free podcast downloads. You can get them at iTunes, Google Play, or Spotify. And while you're over there, please be sure to leave us a rate and review. Now, if today's show made you think about your life, your financial picture, your taxes, your investments, your retirement, whether or not you can buy that wallet, I don't know. Whether all of it's really working together, I would love to talk with you. Justin would love to talk with you. That's because at KPP Financial, we offer free, no-cost portfolio reviews to help bring, if nothing else, a little bit of confidence to your financial plan. If you're interested, it all starts at investtalk.com. Just click the portfolio review button. Independent thinking, shared success. This is InvestTalk. Good night.